Let me tell you a fun fact. Within the last 2 centuries, more than 90% of the world's millionaires have been created by investing in real estate. But if done incorrectly, without the right knowledge, required skills, or partners, it can also create a ton of problems and a lot of sleepless nights. You feel like sometimes there are way too many gurus out there trying to sell you on a weekend course, or just too much noise to cut right to the facts? Yup, we did too, and this is why we started this podcast. Our goal is to provide real estate investors, entrepreneurs, and enthusiasts with all of the most recent knowledge, secrets, tips, tricks, and tactics so that you can grow your own portfolios, increase your returns, net worth, and most importantly, create generational wealth for you and your loved ones. Remember, this is your real estate career. Information is your sword and shield, so eat hearty, prepare for battle, and grind your way to victory. My name is Tejas Gosai. I'm joined by my partner, Jeremy Moyer, and we welcome you to the Real Estate Investor MBA podcast.
Welcome back to Real Estate Investor MBA. I'm Jeremy Moyer, one of your hosts. My co-host Tejas and I both like to start off all our episodes with a big thank you to all of our listeners. We definitely could not do this without you. We enjoy hearing from you. So if you'd like us to review a certain topic, answer a question that you guys might have, please send those to jeremy@realestateinvestormba.com. We'll do our best to cover those items in future episodes. Also, please check out our new website, rei.mba. You'll find all our past episodes. And if you're interested in following us and kind of staying up to date with what we're doing, please sign up for our free newsletter. It's free to do so. Also, remember to follow us on all different social media platforms where we share a bunch of information. We have a YouTube channel as well, so please check us out there on that platform. So for today's guest, we have Spencer Levy. Spencer is a global client strategist and senior economic advisor for CBRE, the largest commercial real estate firm in the world. Spencer leads a team of global client care professionals around the world who are responsible for account management and client experience programs globally. In addition to his client-facing roles, Spencer serves as a primary company spokesman and is considered one of the most insightful commentators on issues of importance to commercial real estate. He's frequently quoted in major business publications and is host of the CBRE's podcast, The Weekly Take, which is the most heavily downloaded podcast in commercial real estate. So I just came out of a tremendous interview with Spencer just a couple minutes ago, and we cover a ton of information. The primary question was, what he sees as some headwinds for commercial real estate in today's economy. And we touch base upon those. We also talk about some tailwinds that he sees, which is really exciting. And he gives a lot of great insight on some potential markets that have growth potential in 1 year out, 2 years out to 5 or 6, 7 years out. So it's really interesting. I think you guys are going to love it. Hope you guys enjoy the show. Cheers. Welcome back to Real Estate Investor MBA. We're really excited for our guest that we have with us today, Spencer Levy. Spencer, how you doing?
Doing great, Jeremy. How you doing?
I'm doing good. So Spencer, for folks who aren't familiar with you, can you spend a few minutes telling us a little bit about yourself? What drew you to the world of just economics in general and how you ended up with CBRE?
Well, I will give the nutshell story very quickly, but I'll work backwards. I've been with CBRE now for 15 years in a variety of capacities, capital markets, research, and now client care. But the interesting thing about the 15 years is I've been doing essentially the same thing during those 15 years of just advising the largest institutional clients in the world on what they should buy, what they should sell, what some of the key trends are. Prior to that, I was a banker. Prior to that, I was a lawyer. And I give you the thumbnail sketch because I think all of those different skill sets, experiences help me with what my core function is, which is to advise my clients. Now, I do it in my own special way. Maybe it's too special at times, but my special way is not just appearing on great podcasts like yours, Jeremy, but I have my own podcast, The Weekly Take. I'm also very big on social media, and I'm also probably the most, I would say, regular speaker on big stages in commercial real estate in the industry. So all of these ways of communicating help me with what I do, but then I spend the rest of my time in one-on-one meetings with big investors.
Very nice. No, I appreciate that. So for today's show, for everybody that's listening, we're going to cover, I would say, an often asked question, which I think is pretty relevant in today's economy, but can kind of be complicated in nature. This is why we brought and sought experts such as Spencer, to come to the podcast, help unpack this question for everyone. So Spencer, the question is, what are some of the biggest headwinds faced in the U.S. commercial real estate industry in today's economy?
Well, I guess you could look at the glass half empty, half full. So I'm going to answer both of those. I'll say headwinds and I'm sure tailwinds as well, because the truth of the matter is there are some elements of tremendous strength within commercial real estate right now. The fundamentals in multifamily, industrial, hotels have never been better right now. But office obviously has some of its challenges as it relates to the future of work. But I also am bullish on retail. So I would say 4 out of 5 right now are showing great strength. And even office, there's pockets of strength there in some of these high growth markets. That's the good news. So that's the tailwind. The headwind, unfortunately, is the capital markets, where the cost and the availability and the liquidity of the debt capital markets is now in question. It's in question, particularly for those assets that are more challenged, but it's gotten more expensive for everybody. So if you are in multifamily or in industrial, you're looking at a cost of debt that's up not less than 200 basis points from the beginning of the year, and it may even get higher. If you're in office, it's even higher than that, if it's available at all for certain types of office, like value add. But interestingly, while debt has gotten a lot more expensive for retail and for hotels, we're still seeing great volume there, because the difference between the going in cap rate and the cost of debt is still pretty wide. So you can get positive leverage there. You cannot get positive leverage today going in on industrial or on multifamily, though some people are doing negative leverage deals because rent growth is expected to be so strong over the next year or two, so they can get to a positive leverage situation relatively quickly. So I would say the tailwinds are the fundamentals for most of the asset classes. The headwinds are the capital markets, particularly the debt capital markets, which have gotten a lot more expensive, a lot more challenging to get that debt, and in the worst cases, illiquid.
How do you think the Fed is handling the response to inflation? Do you continue to see them raising the rate, shrinking their balance sheet, kind of tightening the capital markets? Or I'd like to get your perspective on that.
Sure. So funny little side note. I happen to be sitting here with a textbook next to me, Modern Labor Economics. I don't know if you can see it on your screen, because I studied labor and economics in college. And I kind of referred to my book as like, well, what's going on here, right? To say what's going on with the labor markets, because it's really the labor markets that are driving many of the Fed's decisions. We saw last week, of course, a very positive jobs report with wage growth, but the wage growth is not keeping up with inflation. So the summary of my answer, what do I think the Fed is doing? First of all, I'll give an opinion, which is I think they're doing a great job. I'm in the minority on that, maybe, but I do believe they're doing a great job because they are talking down the economy without forcing it down. Forcing it down would be raising rates too quickly. Talking it down is what they've done. And we saw the pullback in the equity, capital market, stock market. We saw some reduction in demand for single family homes, some reduction in building in single family homes. We saw a reduction in the price of gasoline, things like that. The Fed doesn't have control over all of it, but has control over some of it by decreasing demand. They can't increase supply, but they can decrease demand, and they've done a good job. Now, what is the Fed going to keep doing? Well, they're going to keep being, quote unquote, data driven. And I'm really looking forward to this week's CPI report. And I hope that it's less than last month's. I hope that we start to see a downward trend, because until we see a objective downward trend in CPI, a consumer price index, the Fed's going to be more aggressive rather than less in raising the short end of the curve, the Fed funds rate. And right now, our house view has them raising the short end of the curve to over 3.5% sometime next year. I hope they don't have to, but if they have to, I hope they do, because it's better to be in an environment with stable prices than one with runaway inflation. I'm not saying we have runaway inflation at the moment, but I think it's close to that.
Do you think they have room to go above that 3.5 if they need to?
Let me put it this way, Jeremy. I'm going to take a wild guess that you did not have a home mortgage in the early 1980s.
I did not. No.
Yes, I see that. It's my perception.
Yep, you're very good.
But if you did, I would tell you that your rate on that home mortgage would have been somewhere between 12 and 15%. I mention that as a framing device because can the Fed raise rates higher than the 3.5%? Yes, they can. But let's say they go to 4%. That's still historically low if you go back to the early 1980s. So I think the investor community should look at it through that prism, number one. And number two, our house view has interest rates coming down in 24. So while the short end of the curve may get up above 3.5% in 23, we think by 24, the end of 24, it could be under 2. So why does that matter? Because most people that buy real estate is a longer term hold, 3, 5, 7, 10 years or longer. And if you're going to be underwriting your exit, you need to be underwriting your exit with a lower cost of capital than you have today.
That makes sense. Absolutely. So I wanted to talk specifically on residential and multifamily, kind of the same thing. But how would you compare the housing market, potentially bubble, as some might be referring in the market that we're in today, to the 2008 real estate market crash and those years that led up to that? Do you see any similarities, any differences between the two?
Well, this market rise has nothing to do with the factors that led to the market rise in 2008. Nothing is probably too strong a word, almost nothing, because in 2007 and 2008, the reason why we had the market bubble then was because of too loose credit standards. And I'm not belittling or besmirching people that some of these loans that caused them, but that's what happened. The home ownership rate jumped at that point from about 62% to about 67%. And it was unhealthy for the market. And then people sold bonds based upon these single family loans. Those bonds were held by institutions, and then the value of those bonds collapsed. And that's why the Fed started buying bonds. They started buying bonds of commercial mortgage-backed securities, residential mortgage-backed securities, and it caused the whole market to seize up and the whole activity of the Fed to change. This time, what it's being led by is equity capital from the buyers and not enough of new housing. Really, the number one issue is there isn't enough housing out there, given how much demand there is for that housing, because of some of the liquidity that many of these would-be buyers or renters have, but also because, well, frankly, we can't build it fast enough, in part because of some of the supply chain woes we've had due to COVID and other factors. Shameless plug, one of the many hats that I wear is I am the co-chairman of the Real Estate Roundtable's Research Committee, and I've written a paper on affordable housing. And the bottom line is that the housing shortage will be with us for a long, long time, even if we do see, and we are seeing, a pullback right now with respect to the single family home buyer. The multifamily market has never been hotter. We have double-digit rent. We just had almost 15% growth in the second quarter. So very different than that time, because we did not cause the bond market to essentially collapse, which is what happened back then because of poorly underwritten loans. We don't have that today. It's a very different dynamic, largely led by not enough supply of housing.
That makes sense. So I talked to a lot of different investors, and I love listening to different people's perspectives. The supply and demand imbalance of housing, I mean, it's pretty much all over the country, but it's subsections of, different areas in the country, or it's more pronounced than others, right? And with population, demographic movement, migration, how important is that metric alone? I mean, obviously you need to be, global in your thinking, but how important is that metric alone when evaluating, let's say, put on a hat of a multifamily investor? Should you put all your eggs in the basket on the supply and demand? There's an imbalance, rent's just going to automatically go up.
Yeah, I would say as a multifamily investor, I had a conversation the other day about Nashville's a market that if you take a look at the numbers, not just in the multifamily sector, but also in the office sector 5 or 6 years ago, would have scared you to death, because they looked like there was going to be an enormous oversupply in the market, right? That's what the numbers said. The numbers were wrong. And why were the numbers wrong? Because they underestimated the inflow of the number of people coming to Nashville. So they actually were undersupplied. Austin, Texas, similar metrics. I was just in Salt Lake City, similar metrics. And so the most important thing for a multifamily developer is projecting that demand. Because if you build a job and you don't have that demand, or it doesn't lease up as quickly as you think it's going to lease up, you will very quickly devalue your asset. And so supply demand is clearly the most important metric, generically speaking. But I think when I look at multifamily, as I do with most other forms of real estate, I go back to a phrase that was said by James Carville, who was the political advisor to Bill Clinton. He said that, quote, demographics are destiny from a political standpoint. I would say that demographics are destiny from a real estate standpoint. And that includes not just a market, but increasingly the submarkets within those markets, because you can go to a major city and have very challenged areas, but some incredibly strong areas, and they constantly change. So you take a look at Atlanta. Atlanta, the hot submarket in Atlanta for most of the last 15 years was Buckhead. It's not anymore. Now it's Midtown. And Midtown was a sleepy little submarket. But people discovered that Georgia Tech University was there. They have terrific retail. The Pot City Market is one of the great retail places in America. It's just a beautiful, cool food court / other things. A lot of major corporations have moved there. A lot of people are building there. I'd say a similar thing about Fulton Market in Chicago was a place that was a sleepy little submarket. Actually, was the meatpacking district, literally in Chicago. Now one of the hottest submarkets there. So, but why is that? Because demographics, people move there. It's not much more complicated than that. So demographics is destiny in multifamily. It's destiny in most other forms of real estate. But people really need to focus hard on the submarkets today, much more so than they've done in the past.
Okay, that makes sense. So I wanted to kind of change direction a little bit and talk about, again, to the economy. The Fed, let's just continue to say the Fed's going to continue to tighten the money supply, right? Let's say they push us. Some say we're in a recession now. Some say we're on the brink of recession. Let's say we go into a recession or we're already in one, right? How does that affect the other, commercial real estate is very broad, right? We were just talking about multifamily. Let's talk about like office or retailer and industrial. How does that affect those subsectors of commercial real estate from an operator standpoint? What do they need to be aware of? What do they need to look for?
Well, as the Fed tightens, you're going to impact two basic factors. One we've already talked about, which is the availability of capital. And because they tighten, capital gets more expensive, capital gets more scarce. So on the capital markets front, that's probably the day-to-day most important factor for people who are looking to buy, sell, or refinance. But what will also happen as the Fed tightens is if they impact other portions of the economy, most notably the stock market. If the stock market goes down, you lose what's known as the wealth effect, and the average consumer feels less wealthy, even if it's just their 401k going down. In fact, University of Michigan studies, sentiment surveys have been hitting all-time lows, I think largely because of that. The average consumer will spend less, which will impact non-discretionary spending on certain forms of retail and travel. So their sales per square foot will go down. So I think those are the two things that would be largely impacted by the Fed's action. Now, the one thing that will be positively impacted by the Fed's action is that the cost of goods will come down. So things will be a little bit cheaper, and that's a good thing. And now the thing that the Fed fears more than inflation is deflation. So I think the reason why the Fed allowed the economy to run hotter for longer was because of that bias against deflation. Because the reason why people hate deflation is because what it means to the average consumer is that it's going to be cheaper tomorrow. I won't buy today. I should have to buy tomorrow. But inflation will make them buy today because they think it's going to be more expensive tomorrow. So by tightening, you're going to be deflating the economy to some degree, hopefully not causing deflation, but certainly lowering inflation. Consumers will spend less. Cost of capital will go up. So there will be less activity for capital goods, both from the landlord community, but also from consumers for things that require a loan, like a car or a single family home.
And that could translate directly into multifamily with softening the renter market. Do you see that as a possibility? I know the supply and demand is very imbalanced, so that's a tailwind, right, for that industry. But
of course, it's an imbalance. Of course, it is, right. And so part of the reason why you're seeing markets like New York do incredibly well right now in the multifamily market is because of pent up demand, not just from the age cohort that normally would have gone to New York, which are recent college graduates, but also the cohort that was before them, right? So they have basically two age cohorts trying to go into the same number of apartments at the same time. What do you think is going to happen? Rents are going to go up. You're seeing that in a lot of popular markets as well. You're seeing that impact lots of things. COVID caused all these demand distortions because you had twice the amount of demand than you normally would have because of this lost year or two of people living at home or elsewhere now want to get out into, the real world, the living independently world.
Sure. No, that makes sense. No, I appreciate that. So we're focusing a lot on the headwinds. You mentioned in the very beginning, there's a bunch of tailwinds that you see. I'd like to get your perspective on that as well, if you don't mind.
Well, I mentioned many of them already. They have to do with the fundamentals have never been better in multifamily, industrial, hotels. Retail fundamentals are excellent as well. Office is the one that you're seeing this mixed picture. A tailwind you're not seeing, maybe this should go into the headwind category as I jump back and forth, is foreign capital flows. Now, we did see very good foreign capital flows in the first half of the year. So the data actually is contrary to what I'm saying looking backward. But going forwards, because the US dollar has gotten so strong, that materially increases the hedging costs of buying in the US. So I was speaking to one of my German clients the other day, and they said that because the US dollar is so strong, it costs them over 2.5% per dollar per year in order to invest in the United States, which is a lot of money. And so the bottom line is we're not likely to see the same level and amount of foreign capital that we saw last year, this year. I know in addition to some of my German clients who have been calling into question the relative costs, I know South Korean capital has made a similar statement that it's going to be very challenging for them to invest, in part because of hedging costs.
Okay, that's interesting. I never even thought about that. So I think I can probably assume what your answer would be on this, but I want to hear you kind of explain it. But if you had a crystal ball, right, the types that would thrive over the next year, 2 years, and I'm sure it's, geographically, related as well. But like, what would you say you see increasing on the horizon?
Well, I guess if you're going to look in the next year or two, it's going to be different than my answer for the next 3 to 5 to 7 years, right?
Mm-hmm.
So what I try to do for my investors is I try to find where is the best risk adjusted return, right?
Mm-hmm.
So we all know that multifamily and industrial are doing great fundamentally today. The capital markets, while they've gotten more expensive, are still very liquid. But is that the best risk adjusted return you're going to get? Because cap rates are still very, very low and you're going to have to go through negative leverage.
Mm-hmm.
And so I think the obvious answer is I just say industrial multifamily, but I'm not going to say that.
Mm-hmm.
I'm going to say open air, non-grocery anchored retail. And why do I say that? Well, first of all, I'm biased. I wrote a paper on that. The reason is that, number one, the fundamentals are strong. Number two, the delta, the difference between their cap rates and their expected rent growth is the widest in all of commercial real estate. And number three, institutional investors are scared to death of going in. And why? Because they got hit so hard on retail over the last decade, they now have a bias against it, which is precisely why you should enter the space. You should hit it where they ain't, to use Shoeless Joe Jackson expression. And that's where they ain't today, but they will be tomorrow because of this positive leverage spread. And more of the institutions that I speak to, like open air, non-grocery anchored retail, for that reason. Now, when I say non-grocery, it doesn't mean I don't like grocery anchored retail. I do, for the same reason everybody else does. It has permanent foot traffic. It is necessity retail, but it is priced fairly. It is priced probably 200 to 300 basis points below on a cap rate basis of non-grocery anchored. Now, when I say non-grocery anchored, I mean neighborhood centers. I do not mean malls or second tier malls. So I'm very narrow in my definition of what I'm saying here. But nevertheless, go to the places where you can get the best risk adjusted returns. Just don't go to the places that have the best fundamentals.
Mm-hmm. And when you say open air, just in case anybody doesn't understand who's listening, do you just mind explaining that real quickly?
Sure. I mean, there's malls, which are closed. Most malls, there are some open air malls, but really what I'm talking about is neighborhood centers that tend to be smaller, $20 million and below, that have this neighborhood type of retailers in them. The Starbucks, the dry cleaner, Chinese restaurant, the Chipotle, things like that. Because I think that those are the types of retail that's going to do well. People are going to travel there and be somewhat internet proof. So I think that's the type of retail I'm talking about. And part of the reason why institutions don't like it is that it's 20 million and below. That is a price point that's typically too small for them. But then they talk out of both sides of their mouth because institutions have been backing up the truck on self-storage and industrial, very often paying lower than that price point too.
Right. And then the metric then, or metrics that you look for those certain locations, is it 100% geography? Is it demographics? Is it increase of sales in, the retail in those areas? Just curious.
It all comes down to demographics once again. So if you go to self-storage, which is a fairly niche asset type, there is no asset type that is more locally focused than self-storage. So you can go to a big market like a Dallas and you can say, oh man, they're building too many of these things. And then you say, well, let's see where they're building these things. And they're building them in the pockets that have the great demographics in terms of the density of people, the wealth of the population, other factors. And so, you know what? They're not overbuilding there. So I look at demographics first, second, and third. And then I look at supply and demand of the asset type in question. I think that's how I underwrite what I like the most. And quite candidly, one of the reasons why I like neighborhood centers is not building anymore. And so that's yet another factor that goes into supply and demand that makes it attractive.
That makes sense. No, I appreciate that. So, there's so much information out there, sometimes at our fingertips, sometimes it's overwhelming, right? Can you share some news outlets, media channels, other people you might listen to to gain additional perspective on macroeconomics or even in commercial real estate niche, obviously other than CBRE, of course, that our listeners might be able to check out as well?
Well, other than your terrific podcast, Jeremy, I have my own podcast, as you know.
Yeah, we'll definitely,
which I encourage people to listen to. But I read a lot of the traditional news sources. I read all the major newspapers every day. I also read some non-traditional papers like The Economist and the Financial Times. I'll tell you what, if everybody on this call read The Economist once a quarter, cover to cover, just one edition of it, once a quarter, cover to cover, you would go light years beyond where you believe you are today. That is a hard read. Every time I read The Economist, it probably takes me 3-4 hours at least to get through one edition of it because it's that densely written with great information. But then I also read some of the real estate rags, which would include Commercial Mortgage Alert and other things like that. But the most important way I get information is the old-fashioned way. I talk to my clients every day. Mm-hmm. I travel to markets. I walk cities. When I go to a city that I'm not familiar with, I'll end my day early and just walk the city to understand it. And because I think there's no better way to understand real estate than to see it, touch it, feel it, understand the market with your own eyes.
That's tremendous. And I appreciate you sharing that. So Spencer, in closing, how can our listeners learn more about you? Follow you on social media. Obviously, we'll link your podcast into the show notes as well, so they can listen to you and all your episodes and whatnot. But how can they follow you and learn more about you?
Well, I'm probably the easiest guy to find, but I don't want you to follow me personally. I mean, you can follow me professionally because LinkedIn and on Weekly Take and come to some of my stage presentations. I'm a very public guy for all the major real estate organizations, ICSC, ULI, NAIOP, you name it. Okay. Mm-hmm. But what I really want people to do here is to be curious. Commercial real estate. Why commercial real estate? Why aren't you in the tech industry? Why aren't you in the energy business? And to do so, I would read our stuff. I'd read some of our competitors' stuff. I would read and think and ask the same question I do. Where can I get the best risk-adjusted returns from an investor standpoint? Mm-hmm. And from an occupier standpoint, what is the purpose of this real estate? Too many times when I meet with my largest occupiers, who I also meet with almost daily, they always talk about cost, efficiency, less is more. I don't talk that way. I say, what is the purpose of this real estate? The purpose of it is to grow the top line of your company, to grow revenues, to attract and retain the best talent. So ask the right questions. Asking the right questions will help you find the right answers more than just reading what everybody else reads, but you should do that too.
No, I love that you just said that. No, that's perfect. If everybody just can take that advice and implement that, I think they'd be super successful. Yeah, absolutely. No, Spencer, I really appreciate your time.
Thank you, Jeremy.
Yep, this is Jeremy Moyer with Real Estate Investor MBA. Please be sure to check out us next time. We'll see you then. Thank you.